Greetings, good afternoon, and good evening to many of you. Welcome to the 10 life insurance myths and beliefs in the African American community. As just said, my name is Terrence Sims, and I'm the Corporate Vice President here at New York Life and Field Director within the African American market. Throughout today's session, we're going to discuss some beliefs or myths that are very common within the African American community. When it comes to perception of life insurance, many of us were not thoroughly informed of the details of what life insurance can truly mean to a family, the significance that it brings to the legacy. And my goal today is to educate and inform, in many cases, even enlighten some of you, if not all of you, with some of the common misconceptions when it comes to life insurance, as well as some key ways on how we can utilize life insurance in ways that are not commonly known. If there are any questions, I encourage you to type them in the chat box in the bottom below. And if you haven't had a chance to type it in the chat box because we end, I encourage you and in fact implore you to reach out to the financial professional who invited you to today's session. If you look to find any more information on any of the topics I discussed, they will be happy and glad to help you and assist. With everything that's going on within the world today, it is important for us to change our family's history. And it starts with you today, to change the narrative of everything that's happening. So I hope that you all have your pens and papers ready, your iPad, your iPhones, whatever helps you take notes. And I look forward to today's session. So let's get started. Now here's our disclosure, just to make sure that everything is taken care of and handled professionally and proper. Now on to our first myth. Now, as I go through these myths, I will read the myth and then I'll also give the reality. So the perception of what we have within the African American community and then the reality of what's really happening. So our first myth is people of color pay high insurance premiums. Now, after taking to many members of the community, certain myths seem to stand out. These myths have had a profound impact on the community and have had led to a significant number of African Americans making unwise, if not poor, financial decisions. In this presentation, we will examine some of these myths, perception versus facts, the impact of these ideas on the community, and how addressing these issues could dramatically change our community and the institutions within. So as I said, we're counting down starting at number 10 with our least common to most common. So the perception that Black people pay higher premiums for insurance may have its basis in historical experiences. Redlining defines the practice of refusing to do business with high-risk customers or in high-risk areas. Racial profiling or redlining has a long history in the property insurance industry in the United States, and that there's nothing that we shy away from when it comes to that information here at New York Life. But what's the reality? Well, the reality is there's a lot of key factors on what affects your life insurance rating, what affects your premiums and the way that it may be calculated. With the diversity of our society, it would be poor business practice for any company to discriminate against a group of people. Therefore, underwriting practices for life insurance do not take into consideration race. An application do not have any questions pertaining to race, in fact. There are many factors that may impact the premium for life insurance, such as high blood pressure, diabetes, or other issues have historically been more common within the African American community. An individual who has medical conditions that impact life expectancy will be charged a higher premium appropriate to the risk. If the risk is too great, that individual may not be able to purchase insurance at any price at all. An individual's lifestyle also influences his or her life expectancy. Certain occupations carry more risk than others, and these risks are accounted for in the underwriting process. The same can be said for an individual avocations. For example, a person that skydives regularly or races cars would have a higher risk rating than someone who collects stamps. A person's economic wealth condition can influence their health as well. People who are doing well financially are more likely to have regular checkups and take care of themselves more often. So let's put it into perspective here. Which would you rather see? In even cases where a person's health, occupation, or avocation does result that person in paying a higher premium, insurance may still be the best possible solution. Too often, what appears to be the problem, the premium, actually is the solution. As you see here in this image, compared to the size of the potential problem, the premium usually represents a portion of the death benefit. By not taking action, an individual may be transferring that problem to the people who depend on them, who are at least able to cope with the size of the problem. Which would you rather see take place? You, right now, pay the premiums, or those who depend on you forced to pay the entire amount of the problem? It's kind of that theory of kicking the can down the road. Sooner or later, we're going to come to that point in that crossroad, so to speak. So we have to make sure that we take the proper action today. Let's take charge, because a person's health can change suddenly, as you clearly know in this current environment. It is important to plan while in good health, because we don't know what the future holds. It is far better to have coverage and not need it than to need it and not have it. Think of kind of like your auto insurance. You don't expect to be in a car accident. You don't even look forward to being in a car accident. But it's good that it's there protecting you. It's the same aspect when it comes to life insurance. Number 9, if I buy life insurance, then something will happen to me. The implication of this belief is that the purchase of life insurance would somehow hasten a person's death. Rationally, we know the probability of death does not change with or without insurance. Some have voiced a fear that having insurance would be an incentive for someone to murder them, because most insurance planning is a private matter between loved ones. It is more than likely a fear of dying and having to be forced to deal with one's morality that keeps individuals from protecting those that depend on them. So let's look at the reality. So far, no one has managed to get out of life alive. Therefore, rather than fear death, which none of us can do anything about, it would be better and more advantageous to fear dying unprepared, as this is a fear we can do something about, a danger we can avert. If we have this realistic fear, this sense of danger, we should be encouraged to prepare and also inspired to make the most of our very precarious human life instead of wasting it. It seems, in some cases, as with permanent life insurance, your policy could accumulate cash value as you pay your premiums. Your policy builds cash value that is guaranteed to grow, tax deferred, tax-free on distributions, and can help meet a variety of financial goals, such as supplementing retirement income, funding a child or a grandchild's education, even paying off a mortgage. Also protecting existing assets, establishing an emergency fund. There's a list of things that life insurance can do, so much more than just the death benefit. Note that accessing the cash value will reduce the total cash value and the total death benefit of your policy, but it gives you the opportunity to not only prepare yourself for what may come, but also give you the opportunity to prepare yourself for what may come while still alive today. Myth 8, I don't want to profit from the death of my child. Really, to contemplate the death of one's child is almost unthinkable because it is so difficult. Any loving parent would never think or want to profit from the death of their child. Unfortunately, it is the very event itself that creates more difficulties for a parent. The unexpected expense could cause a severe financial drain on a family's resources. This would compound the difficulties of emotionally dealing with the most highly charged emotional situation that they can possibly encounter. Continued payment of those expenses would only act as a constant reminder of this traumatic experience. Depending on the circumstances, there could be an additional unexpected expenses over and above funeral costs. Families have had to deal with medical bills at the cost of travel. For example, a teenage son, while driving the family vehicle, caused an accident which took his life. His family not only had to cope with the loss of a son, the cost of his death, but also had to contend with a lawsuit brought by injured parties in the accident. Regardless of the reasons, parents usually need time to adjust. The benefits from life insurance proceeds can be viewed as transition funds that will allow a parent to take time off and have funds to help pay bills or create a memorial or some type of legacy in the name of the child. And if there was a sibling, it allows the parents to be present during this time, as opposed to being forced to go back to work and not being there for the family. Even if there wasn't a child present, but a spouse, a significant other that is impacted and needs an emotional support. Not discussed here is other benefits of permanent life insurance. If the child lives and protection needs decrease, permanent life insurance accumulates cash value that can be borrowed against to help to pay educational costs. It also gives you the opportunity to have funds for retirement, as previously stated. Note that the policy loans decrease the cash value and the death benefit, as I said earlier, but this is still an opportunity for you to see the benefit of if he lives long enough that he or she will be able to benefit from cash value life insurance. Myth number 7, the Lord will provide, therefore I do not need to take action. In an attempt to avoid temptations of the world and live a more pious life, some people confuse trusting in God with relinquishing all personal responsibility for their situations. These individuals profess to be trusting God for the future, and to plan, save, or budget would only be demonstrating of their lack of faith. We are told to be good stewards. Therefore, riches for riches' sake is not good stewardship, and neither is poverty as a result of poor choices and failure to use what God has given you wisely. I do believe God does not call us to be irresponsible. Timothy 5:8. But if anyone does not provide for his own, and especially for those of his household, he has denied the faith and is worse than an unbeliever. The motivation of the heart is what is key. In providing our own, this could include family or our employees, not just our family, but to also think about the people who depend on you. Let's put it in perspective. If we own a business, we are speaking for those who cannot speak for themselves, mainly those who are dependent on us. When we fail to take action to protect those that depend on us, that consequence can be devastating. You can potentially lose the business, forcing others to then be unemployed. So there are other ways to think about life insurance as protecting more than just your immediate family. Myth number 6, life insurance is a bad investment, or I just want term insurance. Life insurance is one of several financial tools and is not an investment. It's one thing I want you to understand. It is a financial tool. Life insurance is primarily designed to provide protection, and that is its core. Investments are designed to accumulate wealth. Although certain life insurance products accumulate cash values, the primary use is for protection. Life insurance is not an investment, nor are investments life insurance. It's not either, but both. Life insurance is there when a person does not have the time to accumulate sufficient funds to take care of his or her family obligations. Even after accumulating wealth, life insurance can be one of the most important tools in efficiently and effectively passing the wealth to others and the next generations to come. The key is sound planning based on your situation. It's not a one-size-fits-all rule of thumb. That's why your financial professional sits with you and goes through your objectives, your goals, and your aspirations, because truly, it's not a one-size-fits-all. Guarantees and promises come with a cost. Now again, life insurance is one of several financial tools. It is primarily designed for providing protection. Investments are designed to accumulate wealth, as I stated. But you use the right tool for the right job. When you go to a car wash that cleans your car, would they use a t-shirt? They might get the job done, but there are other tools that can be used to get the job done better. That's why you have to make sure you're using the right tool for the right job. Our next myth is, I have coverage through work and it is enough. This is a very, very common myth, not only within the African American community, but within every single community within America. The main objective of the company benefit program is to attract and keep employees. It's kind of like the glue. The employer benefit plan does not consider any special circumstances or situations of your family. Everyone's situation is different. By depending solely on the company program, you place yourself and your family's well-being on the decision of your employer. So the question you must ask yourself is this the wisest position to be in? It's not your employer's responsibility, nor are government programs designed to keep your family in their current lifestyle. It's not their expectation, that's not their desire. That is not what it is intended for. As we have seen earlier, the people left behind may be the least able to deal with the loss. When answering the question, who holds the responsibility for your family's future? Those who truly care about protecting their loved ones will make sure they have maximum control of the situation and not leaving it to the employer. And one of the main things that I always say is it portable? You may have life insurance at the job, but in this current environment, we see so many individuals changing jobs, taking on new responsibilities, and then also in some cases, banking on themselves, starting their own business, leaving life insurance at the current employer, or the previous employer, should I say. So I ask you, why not make your life insurance portable? Something that you can take with you when you leave your new job, when you leave your previous job and go into something else, whether it is banking on yourself, starting a new business, or looking for better experiences and better opportunities in future employment. Is it portable? Myth number 4, my parents did not leave me anything and I worked hard. My kids can make their own way. They are on their own. This one always gets me. Often, sometimes some people believe that because their family didn't leave them anything, they should follow the same pattern. Let's consider that their parents may not have had the luxury of good counsel, so they didn't know how to make a lasting difference. Would their life have been different if someone in their family would have had a different outlook? If someone met with your parents and your grandparents and your great-grandparents and had the conversation around transitioning legacies, multi-generational wealth planning, would they have listened and said, that sounds great, but I'm not interested? More than likely, they would have taken a part of this opportunity. Unfortunately, our parents, our grandparents, and our great-grandparents, there was no one to have that conversation about how to transfer wealth and how to accumulate wealth by using life insurance. The conversation was bury grandma, bury grandpa, here's a very small policy, and this is all that you need. So we have to change that narrative. We can do it today. We can do it tomorrow, but I wouldn't wait longer than that. So let's look at the reality here. Irresponsibility versus responsibility. Earlier, we saw from people of faith that perspective that believers are called upon to provide for their families. Dr. Miles Monroe, author and motivational speaker, asked the question, where's the richest place on earth? I'm gonna pause for a second because I want you to think about that. No, it's not Jeff Bezos' house. Most people would say the Middle East or the diamond mines of Africa. He urges that the richest place on earth is the cemetery, because there are many books that were never written, ideas never put forth, leaders who never led, talent, abilities, etc., that died with the individual. Regardless of who you are, any dream not realized or even attempted that die with you is a tragedy. To compound the loss of talents and abilities, is to not prepare to pass on or take care of those who depend upon you. Those who die in that state, Dr. Monroe refers to them as generational thieves. I want you to think about how important it is for you to take responsibility as opposed to irresponsibility. One of our most versatile offerings is whole life insurance. It can help ensure that your family remains financially secure today and in the future provide that premiums are paid when due. With lifelong protection and the opportunity to purchase riders from additional coverage in the future, purchasing a policy today will help protect for your family and set in motion a legacy of protection, as I said. This features like a simple set premium and a cash value that grows over time. So your premium never increases, however your cash value does. Meaning the whole life insurance might be the most important purchase you make to protect your family's standard of living, even if you're not there to provide it. Our next myth. If I leave them a lot of money, they will spend it on somebody else. Or why should I leave him or her with a lot of money to be with someone else? I've heard that one as well. Well, the reality is, if you don't leave enough, this may leave the opportunity for someone to come in and actually take advantage of your family. Not leaving enough may leave your family in dire straits, having to make tough choices, having to depend on others that they more than likely would not have if you put something in place. Having to sell properties, depend on relatives, friends, and charity. Children not being able to attend the colleges that you intended for them to attend, just to name a few. The reason why this belief exists is beyond the scope of this presentation. As Dr. Martin Luther King said, the way Dr. Martin Luther King put it, ultimately a person must decide if he or she wants to live up to the responsibilities of life. Dr. King also said the true measure of a man is not how he behaves in moments of comfort and convenience, but how he stands at times of controversy and challenges. If families, businesses, and our institutions are to grow and prosper to help future generations, we must be people of character with a long-term view and look beyond the emotions of the moment. Our second to last myth, they will just blow it away. Now, an article that was published on BBC.com shares how people who get large sums of money run often through it in 5 years or less. When you look at what happens to most lottery winners, it is easy to come to that conclusion that a beneficiary may not use the proceeds wisely. The influence of our society through advertising creates an immediate gratification environment. Even responsible individuals may find it difficult to make wise decisions and find good counsel at the time that they need it most. However, because of these pressures, it is prudent to gain an understanding of financial tools and the proper use of them. The legacy planning begins with the education, and we must learn so that we continue to influence generations to come. If there are serious concerns regarding how a beneficiary would handle the benefits, there are tools that can be utilized to prevent the outright squandering of funds. Settlement options and trust are ways to rule from the grave, to protect the family's wealth, a family's legacy. So as I said earlier, please consult your professional advisor who invited you to today's session for options that might fit your situation and if this concerns you. If you're not comfortable with your own finances now would be the time to get organized. New York Life provides a tool called Organize Your Life, which helps you organize your financial papers in such a way it will save you time and could and can be the catalyst to have a discussion with your adult children. This gives you the opportunity to educate them and prevent squandering of funds, which is very common concern within the African American community. And our number one most common myth, I only need enough insurance to bury me. Now, as I said, this is the most common belief or myth is that the idea that a person should have enough insurance to cover the cost of a funeral, and that is all the insurance a person needs. This view of one's self-worth and the value they provide to their family rarely ever matches the reality of their situation. This is especially true in just considering what it would take to replace the lost income at death of a wage earner. So let's kind of put it in perspective. If an individual is making, let's say, $50,000 a year, and he or she is 30 years old, they have one child who is 1 year old. Now, the age of the child at this in this point really isn't relevant, but what I want you to think about is they're 30 years old and they make $50,000 a year. So how much time do they have to conceptually retire? About 35 years. Let's say it's 30 years. Say they want to retire a little earlier. What you would do is you would attempt to replace that income that individual was bringing in. God forbid something were to happen today. And how would you do so? Well, very simple. This isn't the core way to do it, but this is a great rule of thumb. Take your age and the amount of years you had to retire. So in this individual's case, it's 30 years. Multiply that by the current earning income wage that individual has. So it's 30 years times 50,000. This individual would need, at a minimum, $1.5 million. That's just to replace the income at the current wage that they're earning over the next 30 years. So if something were to happen to him or her tomorrow, not come back from home, not come back from work that day, they would have to replace that $50,000 every single year. And that's how you would do that. And that's just a rule of thumb, but it's a way for you to understand, how can I replace my wealth? How can I understand what my wealth is to my family, or my value, my economic value to my family? So human capital is the value of your expected future earnings. And for many people, it can be their largest asset. But for a more comprehensive assessment of your total economic wealth, you need to consider your human capital as well as your financial capital. And in part, you have to sit down with a financial professional to go through these steps and processes to understand what your true value is and what your need is. Insurance has been one of the most cost-effective ways of protecting assets from catastrophic loss. Most people think about this in terms of their homes, but we should also consider protecting our human capital as well. So in that scenario that I did of 1.5 million of that need for that individual to have, what if they also had a house that was valued at 500,000? And now you want to make sure that the family stays in that house. So you're starting at $2 million of need. Now, as I said, this is just a rule of thumb, but this allows you to understand where you should be starting the conversation. What are some of the ramifications? This last particular belief has had a significant impact on the African American community. In addition to not fully taking into consideration a person's true economic value, the idea of covering the cost of a funeral provides the person with a false sense of having done something significant. In many cases, the person closes their mind to any future discussions. It allows the person to continue their current spending habits and behaviors and say to themselves, my family would be all right because they do not have to worry about the cost of the funeral. Unfortunately, it is the people left behind who will have to deal with the consequences of this decision. The consequences could negatively impact multiple generations. Therefore, I ask the question, will you be the one to break the cycle? Especially this last myth, which has plagued our community for decades, preventing us from creating multi-generational wealth and forcing each generation that comes after to press restart. Our agents here at New York Life will be able to sit down with you and discuss comprehensive plans that can give you a clearer understanding of your current situation while analyzing, and better preparing you for your future goals. With that being said, I encourage you once again to reach out to your New York Life professional that invited you to the session today. I want to say thank you for your time. Thank you for being the catalyst of change. Once again, my name is Terrence Sims. I'm the Corporate Vice President of New York Life and the Field Director for the African American market. Thank you again and have a wonderful evening. And at this point, I'm going to hand it off back to my host for any questions that you may have.